Thank you, thank you. Can you guys hear me all right?
Yeah.
So my name is Vishal Career. And very quickly about me, because I'm going to offer a fairly different perspective from what you guys have heard just now, as an example. I started my career as a software engineer. Got very interested in investing. My engineering career was predominantly at Morgan Stanley in New York City. Got very interested in investing, so learned investments, and then eventually grew to become a portfolio manager at BlackRock. I did that for several years, and until I learned about Bitcoin and the crypto revolution, got really excited about it, and decided to do something, on my own with a few partners. And that's what Huddle is. That's our startup. And what we've tried to do is really bring what we knew was sort of good in traditional financial services. There's a lot of stigma, and obviously you hear a lot more of the bad news than there is good news. It's typical of most industries. And what we're trying to do is bring the best of traditional finance and combine it with the power of crypto, both sort of the economic power and the cultural power, the new way to set up organizations compared to sort of corporations. So that's what Huddle is about, and we're focused on really democratizing financial services a lot more broadly, not limited just to digital assets, but the whole gamut of financial services. So let me take a few minutes just describing what the U.S. financial backdrop is that we live in today. And some of these numbers, if you haven't seen them before, will definitely surprise you. So let's start with a quick sort of survey of what our backdrop looks like. So FINRA does this survey. It's on their website online. The website's called usfinancialcapability.org. They ask you 5 questions, 5 or 6. And if you can answer more than 3 questions right, you're financially literate. If you cannot, if it's 3 or less, you are financially illiterate. And they're fairly simple questions. Give it a shot if you haven't already. 63% people in the States cannot answer more than 3 questions right. So they're financially illiterate is it's a simplistic definition, but gives you an idea of very basic questions people are not able to answer. 60% do not have an emergency fund. This is from a study done by Bankrate.com. So they describe emergency fund as about $1,000 in unexpected expenses. If you have that, where are you going to pay it from? And it turns out 60% of the people they surveyed do not have an emergency fund, and this is all in the U.S. So that's one side of it. The other aspect of the financial situation generally today is that wealth inequality has only been getting worse over the years. So it's 25%. Wealth of the nation was owned by 1% of the population back in the 70s. Now it's 45%. So that's how much concentration of wealth we've seen over the last 40, 50 years. So on one hand, you see wealth concentration increasing. On the other hand, the opportunity that's available for average investors, somebody who's not accredited, doesn't have $1 million in assets or so, has been shrinking. And this is one example of that. There were 7,000 publicly traded stocks in the US back in the 90s. Now they're around 3,500, right? So half of those stocks are gone, variety of reasons, right? One, it's the venture capital, angel investors, they've realized that they can actually make a lot more money keeping the stocks private or keeping the companies private and letting them go public much later. So there's a lot more unicorns now compared to what you had a few years back. And the other aspect of it is regulations and the overhead that a corporation has to take on once they go public, the additional reporting they have to do and all that. And that becomes a deterrent for if they can source the capital privately, and not have to deal with all that bureaucracy, then they would rather do so, and that's resulted in number of stocks, publicly traded stocks, decreasing quite a bit. So 3,500 stocks is what trades, in the U.S. markets today. Interestingly enough, a mutual fund or an ETF, right? Its job basically is to give you a diversified portfolio. So if you don't know which stocks to pick, or you don't want to deal with that, you just want a basket of stocks, you would buy a mutual fund, right? So you would think with 3,500 stocks, how many different mutual funds do you possibly need to basket these stocks? How many different ways you wrap these stocks, right? There's more than 10,000 mutual funds. Now, not all of them are stock mutual funds. Some of them are bonds and in commodities and what have you. But even half of them were stock mutual funds, right? You have 5,000 wrappers on top of 3,500 stocks. Like, how many different ways can you package the same product, right? So this is something an end investor faces, is the amount of choice. Now, choice is good to an extent before it becomes bad, in the sense that it starts leading to indecision. There's just so much, and they look kind of similar, and they behave kind of similar in terms of the returns that you get on these things. But there's just so many of them, and that results in a different problem, which is essentially indecision. Where the fundamental opportunity is being taken away, a lot of packages are being created around it. So it creates a lot of complexity in the financial space. And this is, another number in terms of the amount that people end up paying in fees if you hire an advisor and get professional advice. So this is an example of $10,000 invested per year for 40 years. So typical sort of working span of a person, if they were investing $10,000 for 40 years, $10,000 per year for 40 years, and earning about 8% return, paying advisory fees of 0.75%, so 75 basis points, that would amount to $500,000. So that's the amount you would end up paying in fees for professional advice, right? So there's too much, it's too complex, advice is expensive, and that's sort of a broad state that we live in. And this is, I think, the last statistic I have here. But the result of this is that only 54% of the general population trusts financial services. So financial services happens to be the least trusted sector. And so if you compare with other sectors like technology and energy, what have you, financial services happens to be the least trusted sector. People don't understand. There's too much complexity. Too many fees, hard to get your head around what's going on, and that's why a lot of people don't trust it, right? So, so that's the backdrop that we're operating in, what we're trying to do, the solution that that we're building at Huddle. Is what we define as a social financial marketplace. And I'll describe what that means, but this is how we intend to at least make a difference to the situation in a meaningful way. So what is Huddle, and what does a social financial marketplace mean? And sorry, we had to come up with some way of explaining what Huddle is, and that's essentially our short descriptor of it. But what is it? Huddle as a platform, what it allows you to do is people can come together, discuss investment ideas. So it's a social platform, it's a social network in a financial context. You come together, discuss investing, finance, savings, banking, essentially sort of the financial space. So that's sort of the social tier, the interaction layer, if you may, of Huddle. You can formalize some of those groups that you form, or clusters is what we call them in Huddle, that you form, into pools of assets. So 5 people come together and say, okay, we'll pitch in $1,000 each. We have $5,000. Now we can probably get access to an investment opportunity that we would not have been able to on our own, right? So an example would be, say, you're looking to invest in a hedge fund, and they have a $100,000 minimum. Now, you might not be able to do it on your own, but 10, 15, 20, 100 of you got together, you would be able to get access to investment opportunities that way. Another benefit you would get would be a lot of mutual funds have a tiered fee structure. What that means is if you're the retail client, you usually end up paying higher fees. If you're an institution, you have a lot of money, you'll pay less fees. Exact same product, exact same service, you're paying more in fees, right? So the structure essentially allows us to lower the minimums and get people access to investment opportunities that either they would not have been able to access on their own, or if they were able to access, it would be at higher fees, at higher minimums, right? So it sort of lowers the barriers for investment opportunity. So that's essentially the platform. So the key benefits of this the sort of social financial marketplace, if you look at it from the user's perspective. So what the users get is access to financial opportunities. So you can share ideas, views, opinions, pool money to boost collective buying power. So we're sharing ideas and views. That's sort of at the informal level. You can formalize that and start pooling money and form an example in sort of traditional world would be like an investment club, right? And these form very organically. And this would be a platform to kind of take your clubs online. Would be one example of how people could use the platform. You'll get access to previously denied opportunities. I explained that already, and pay lower fees, right? So these are some of the benefits that come out of a platform where you're leveraging people's collective buying power. Now, the other side of Huddle is that it is a marketplace. What that means is at Huddle, we are purely a technology platform. We do not manufacture any of the investment products. So we're not a bank, we're not an asset manager, we're not running our mutual funds on here or what have you, right? What we provide is for established banks and providers in their space to be able to come and list their product on this platform, right? So we're connecting providers who already have good product. We sort of do the curation of this product at Huddle, but we're providing that space where providers who have good product can come and access end investors in a very direct way, right? So the benefit they get is a larger expanded customer base and more distribution channels. So that's something that providers love, and a direct access to end investors. This is also actually been a major issue in the traditional asset management space, in that you might be buying, like I used to work for BlackRock, so I'll just use that as an example. You might be buying a BlackRock's mutual fund or one of their ETFs, but they don't get to interact with you directly, right? You're buying this product on some platform that's not sharing your information with them for right or wrong reasons. But what this does is allows the end sort of financial product producer to interact with the end investors, right, and have a dialogue and receive feedback about how their product is being perceived by the population. So, which is quite beneficial to the providers. So that's sort of the interaction that it opens up, because it's essentially a marketplace. It's asset class agnostic. So you could. The kind of products we're looking to offer, would be all the way from your checking and savings accounts, all the way to diversified stock and bond funds, hedge funds, crypto funds, what have you. Not all of this would become available in sort of the first iteration of the product, but the way the platform is designed, it is asset class agnostic. It doesn't really matter what it is that you're trying to invest in on this platform, as long as there is a provider of the investment opportunity and there is demand for it. Then we sort of do the matchmaking. So you could be selling a painting on here or what have you. The whole platform is powered by the HODL token. So this is where we felt the economics or utility economics or crypto economics, however we want to phrase it, was a very powerful mechanism that we could leverage on the HODL platform without making it cost additive. So the issue with providing financial services is, there's already an existing stack of a lot of people who, take sort of their cut or their fees for the work that they're doing, right? Nothing wrong with that. And we wanted to figure out a way to not be cost additive to that. So we're leveraging a token to do so. So it essentially, as the HODL platform grows, right, the token essentially sort of fuels the growth of the platform without us having to charge excessive fees or what have you, right, for the platform to be do economically viable. So the way the token gets used is it is the preferred form of payment on the HODL platform, which HODL is essentially a subscription platform, and the token helps us subsidize the payments the subscription fees that users would have to pay, and it fuels the rewards and loyalty programs. So users and contributors of all sorts will get rewarded HODL tokens for the contributions that they're making or for the investments that they're making, and then they can use those tokens to pay back subscription fees, right? So that's the very basic mechanism through which we're leveraging the HODL token for starters. It could have a lot of other applications down the road, but we're starting out with a sort of a simple mechanism that people understand. So it's very much like your airline miles or Starbucks reward points or what have you would operate that way before we find further more sophisticated applications for it. So that's how we're leveraging blockchain and the HODL token in the ecosystem. I'll start wrapping up here. So when we think about, our tagline is access granted. So when we think about financial access, we're thinking in terms of complete access. So it's not only giving you access to the financial opportunity, but the information around it, the behavioral guidance around it. We have essentially sort of questionnaires and algorithms that help matchmake or provide you the necessary sort of behavioral guidance around investing certain opportunities. An example would be if you're investing in a high-risk asset, it'll ask you questions about, do you realize that this thing could go down 60%? Are you prepared for that kind of loss? So providing you that, that behavioral guidance, and then, the social layer that we've already talked about. So that's basically it. We're finishing up our test. We're looking to launch the platform in the US later this summer on iOS and Android, and there's a web app for the providers for it. You can find out more about us at ihodl.com. That's our website. And we are looking for, because we're building this marketplace and need a lot of sort of contributors to it, whether you're a user of the platform or whether you have a financial product that you could be offering on the platform, or investment content. We're looking to collaborate with strategic partners, if you may. So if you have any ideas that you would like to share with me, feel free to find me after the talk. Thank you very much. That's my email address as well, if you want to contact me that way. Thank you.
Thanks, Vishal.